Alternative investments, private equity, real assets, the full picture. Hey everyone, welcome back. If you look at what the ultra-wealthy actually hold in their portfolios, not what's reported in the financial press, but what the data shows, something interesting emerges. They don't hold very much in the way of public equity index funds. Surveys of family offices, the private investment arms of individuals and families with $100 million or more in assets, consistently show that 40 to 60% of their portfolios is in assets that most ordinary investors have never heard of, let alone accessed. Private equity, hedge funds, private credit, infrastructure, farmland, timber, and a range of other alternative asset classes. Why? Is this just conspicuous investment consumption, complexity for its own sake? Or is there a genuine structural reason why the wealthiest investors in the world systematically allocate away from the public markets that the rest of us rely on? Today we're going to find out. We'll examine the allocation data, explain how private equity and hedge funds actually work, explore the real asset categories gaining the most attention, and look at the Yale endowment model, the most influential alternative investment strategy of the past 4 decades. We'll also be honest about the limits of these strategies for most investors. Before we examine individual alternative asset classes, let's look at the aggregate picture. How portfolio allocation actually changes across wealth levels. The pattern is striking and consistent. As wealth increases, the allocation to public markets decreases and the allocation to illiquid alternatives increases. Why? The first reason is the liquidity premium. Private, illiquid assets, private equity, infrastructure, private credit, offer investors a higher expected return as compensation for being unable to sell quickly. This illiquidity premium is real and documented. A retail investor who might need their savings for emergencies, job loss, or a mortgage can't afford to lock up capital for 7 to 10 years. An investor with $50 million can easily keep 10% of their portfolio locked up for a decade if the expected premium is worth it. The second reason is access. The top-tier private equity funds, the best-performing hedge funds, the most sought-after private credit vehicles, these have minimum investments of $5 to $50 million and accept only institutional investors or the ultra-wealthy. This isn't just a financial barrier, it's a deliberate exclusivity that creates structural advantages for those inside the club. The third reason is correlation reduction. Adding asset classes whose returns don't move in sync with public equity markets, infrastructure cash flows that are contractually linked to inflation, private company returns that are appraised quarterly rather than marked to market daily, reduces measured portfolio volatility. Whether the volatility reduction is real or a function of how private assets are valued is itself a contested question. But the diversification motive is genuine. Private equity refers to investments in companies that are not publicly traded on stock exchanges. The asset class takes several distinct forms. Buyouts are the largest component by capital deployed. Firms like Blackstone, KKR, Carlyle, and Apollo acquire mature businesses, often ones that are underperforming their potential or undervalued relative to what an active owner could achieve, restructure their operations, and sell them 3 to 7 years later, typically to another PE firm, a strategic acquirer, or the public markets through an IPO. The leverage component deserves particular attention. In a leveraged buyout, the PE firm typically funds 30 to 40% of the acquisition price from equity and the remainder from debt. This financial lever amplifies returns dramatically, and losses as well. A company purchased for $1 billion with $300 million in equity and $700 million in debt that sells for $1.5 billion returns $500 million on $300 million invested, a 67% gross return, even though the business only increased in value by 50%. The leverage did the rest. Venture capital sits at the opposite end of the risk spectrum, early-stage companies where the vast majority of investments will fail, but the rare successes, the Googles, the Ubers, the Facebooks of their eras, return many multiples of the initial investment and make the overall fund profitable. VC is fundamentally a power law business. Returns are driven almost entirely by the few outlier investments, not by the average. The performance data on PE is complicated and contested. The best PE funds have delivered outstanding long-run returns, genuinely exceeding public equity benchmarks by substantial margins. But the average PE fund, net of fees, has not consistently outperformed a simple equity index. The difference between the top quartile and the median is massive, and unlike mutual funds, PE fund quality is persistent. The best managers continue to be the best managers. Access to top-tier PE is itself an asset. Hedge funds are perhaps the most misunderstood category in alternative investments. The term describes not a single strategy but a legal and regulatory structure, private investment vehicles that can employ a wide range of strategies unavailable to regulated mutual funds, including short selling, leverage, and derivatives. The major strategy categories: long/short equity funds buy stocks expected to rise and short stocks expected to fall, aiming for market-neutral returns that don't depend on overall market direction. Global macro funds make directional bets on currencies, interest rates, and commodities based on macroeconomic analysis, George Soros's famous short of the British pound in 1992 being the archetype. Event-driven funds exploit price dislocations around mergers, bankruptcies, spin-offs, and other corporate events. Quantitative funds use statistical models and algorithms to identify patterns in market data. The cost structure of hedge funds is their most significant structural disadvantage. The traditional 2 and 20 fee structure, 2% of assets under management annually, plus 20% of profits, creates a massive headwind to net returns. A fund generating 10% gross returns pays out 2% in management fees and potentially another 1.6% in performance fees, 20% of the 8% net, delivering 6.4% to investors. That's before accounting for the opportunity cost of not simply holding an index fund. The aggregate performance data for hedge funds as an industry is not flattering. The HFRI Fund Weighted Composite Index, a broad measure of hedge fund returns, has significantly underperformed the S&P 500 over the 15 years from 2009 to 2024. Warren Buffett's famous decade-long bet against hedge funds, wagered in 2007 that a simple S&P 500 index fund would outperform a basket of hedge funds over 10 years, was won decisively. The legitimate use cases for hedge funds exist, but they're narrower than the industry's reputation suggests. In genuinely volatile, bear market environments, 2001 to 2002, 2008, to a lesser extent 2022, certain hedge fund strategies have provided meaningful downside protection. And the top-tier managers, Renaissance Technologies Medallion Fund, Bridgewater's Pure Alpha strategy, have delivered returns that are genuinely extraordinary. But access to these is either closed or requires hundreds of millions in minimum investment. Real assets, investments in physical things rather than financial claims, have attracted increasing attention from institutional and wealthy investors, particularly in the inflationary environment of 2021 to 2024. Infrastructure has become one of the largest and most rapidly growing alternative asset categories. Airports, toll roads, ports, electricity transmission networks, water treatment plants, and increasingly renewable energy facilities, these assets share several characteristics that make them attractive to long-term investors. Demand is highly inelastic. People use electricity, water, and roads regardless of economic conditions. Revenue is often contractually inflation-linked. Toll increases are tied to CPI, utility rates are regulated with inflation pass-throughs. Cash flows are predictable over decades. And the assets are difficult to replicate. You can't easily build a competing airport next to an established one. Farmland has quietly become a significant holding in many large endowments and family office portfolios. It offers a direct claim on one of the world's most fundamental resources, agricultural production capacity, in a world where productive farmland is finite and increasingly scarce. Returns come from rent income and land value appreciation. Farmland values have historically tracked inflation closely, providing genuine purchasing power protection. The University of Illinois has tracked U.S. farmland returns since 1950. The long-run real return is approximately 5 to 6% annually. Commodities, oil, natural gas, agricultural products, industrial metals, provide a direct inflation hedge, since commodity prices are themselves a major driver of inflation. The simplest exposure is through commodity futures indices or commodity ETFs. Direct ownership of physical commodities requires storage, transport, and insurance infrastructure that most investors can't practically access. Art, wine, rare cars, and other collectibles represent a small but real segment of ultra-high net worth portfolios. The May-Moses ART indices suggest long-run ART returns of 5 to 8% annually, with correlation to public equity markets that is genuinely low. However, transaction costs, auction commissions of 12 to 25%, storage, insurance, authentication risk, and the fundamental illiquidity of individual pieces make ART an investment vehicle primarily accessible to those with both financial resources and genuine expertise. No discussion of alternative investment allocation would be complete without examining the Yale endowment model, arguably the most influential institutional investment strategy of the past 4 decades. In 1985, David Swensen was appointed Chief Investment Officer of Yale's endowment, then valued at approximately $1 billion. The portfolio at the time was conventionally allocated. Heavy in domestic equities and bonds, with minimal alternative exposure. Over the next 3.5 decades, Swensen systematically transformed the allocation, dramatically increasing private equity, real assets, hedge funds, and venture capital while reducing conventional public market exposure. The results were extraordinary. Over Swensen's tenure from 1985 until his death in 2021, Yale's endowment compounded at approximately 13% annually, generating over $40 billion in returns on the initial $1 billion starting value. The fund grew to approximately $42 billion, funding over 40% of Yale's annual budget. In the fiscal year ending June 2021, Swensen's final year, the endowment returned over 40%. The Yale model became enormously influential. Harvard, MIT, Princeton, Stanford, and virtually every major university endowment restructured their portfolios along similar lines. Pension funds, sovereign wealth funds, and family offices adopted versions of the approach. The core idea, that illiquid alternatives offer genuine return premiums and diversification benefits that justify their complexity and illiquidity, became orthodoxy among institutional investors. But Swensen himself offered a critical caveat that is often ignored by those eager to replicate his success. In his book Pioneering Portfolio Management, he wrote that the model depends critically on access to top-tier managers, and that for investors who lack that access, investing in average or below-average alternative funds will likely produce worse results than a simple index fund portfolio. He was explicit. For individual investors without institutional relationships and the ability to conduct rigorous due diligence, low-cost index funds are the appropriate vehicle. This is the central paradox of alternative investments. The structural return advantages are real, but they accrue primarily to the investors who can access the best managers, have the capital scale to justify the costs, and can absorb the illiquidity for the necessary time horizon. Mimicking the allocation without mimicking the manager access is a prescription for paying alternative fees for index fund performance. The ultra-wealthy invest differently from ordinary investors, that's the factual starting point of this episode. And the reasons are structural, not arbitrary. Access to illiquidity premiums, manager relationships that generate genuine alpha, asset classes that reduce correlation to volatile public markets, and the capacity to absorb multi-year lockups that most investors simply cannot afford. For the vast majority of investors, those without access to top-tier private equity funds, without the minimum investment requirements, and without the due diligence infrastructure to evaluate managers, the practical alternative exposure available is limited to REITs for real estate, commodity index funds for inflation-linked returns, infrastructure ETFs for regulated asset exposure, and potentially some of the newer retail-accessible private credit or private equity vehicles, each of which comes with its own cost and liquidity trade-offs. The deeper lesson from this episode is not buy what the rich buy. It's understanding why the rich buy what they buy, the structural logic of illiquidity premiums, inflation protection, and genuine diversification, and asking what version of those structural benefits you can access at your scale and with your constraints. Sometimes the answer is very little, and index funds are still the right choice. Sometimes there are genuinely useful additions. The key is understanding the logic, not copying the allocation. Thanks for watching. A subscribe and like makes a real difference for the channel. See you next time. Note: educational content only, not financial advice. Alternative investments carry significant risks. Thank you so much for watching until the end. If you have any questions or comments, feel free to leave them below. We're also looking for topics you'd like us to cover next, so let us know. Don't forget to subscribe and hit the like button if you enjoyed this video. Don't miss the next episode. Subscribe to the channel and hit the bell.